The big banks just declared their Q1 FY26 results. Loan growth is down, margins are shrinking, and credit demand is muted. Yet the stock prices are holding up. So, what is going on? Is the Indian banking engine failing, or are we finally at the bottom of the cycle? Let's break this down nice and easy. If you are an investor in HDFC Bank, ICICI Bank, or even broader financial sector mutual funds, you need to pay attention. The data coming in tells a very clear story. We're going to unpack bank earnings, the slowdown in corporate credit, margin compression, and whether things are turning around. And by the end, you'll have a clear picture. Is the worst behind us, or is this the beginning of a structural slowdown? Let's start with the numbers. Corporate loan growth across top banks has collapsed. In June 2024, HDFC Bank was growing its corporate book at 19%. A year later, it is just 1.7%. ICICI Bank has dropped from 10.3% to 7.5%, and Yes Bank has dropped from 14% to 2.7%. Union Bank is also down 2.7%. So, what does this tell us? India Inc. is not borrowing from banks. But why? Well, the answer is simple. Capital markets are winning. 15 lakh 70,000 crore rupees have already been raised via capital markets in FY25, a 33% jump. Bond yields for AAA companies are between 6.85% and 7.18%. Compare that to bank lending rates where the weighted average is over 9.2%. It is cheaper and faster for large corporates to tap bonds rather than go through the paperwork. Now, this is a structural shift and banks are the ones bleeding. But it is not just credit growth. Margins, which are the bread and butter of banks, are also under pressure. RBI has cut the repo rate by 100 basis points since February, and loans, especially floating rate loans, are repriced immediately, but deposits are fixed rate and they take time to adjust. So, what happens? Banks get squeezed. HDFC Bank's NIM or net interest margin fell to 3.35%, down from 3.46%. ICI's NIM is slightly better at 4.34%, but that too has compressed from earlier quarters. And margins are expected to fall further in Q2 before stabilizing. So we are still not fully out of this compression cycle. Now, earlier banks could rely on strong retail loan growth to compensate for weak corporate credit. But that is slowing too. HDFC Bank reported only 8.1% growth in retail loans. Auto loans and housing are also facing slower demand, especially beyond tier 1 cities. Now, ICICI Bank had better numbers. Retail loans were up 6.9%, business banking loans were up nearly 30%, but even here, growth is more tactical than broad based. Interestingly, MSME loans are showing resilience, partly due to export front loading, businesses trying to ship goods early ahead of possible tariff risks from the West. So, yes, MSMEs, credit cards, and personal loans are the few segments still alive, but they're not enough to carry the full weight of the banking system. But here's where things get interesting. Food inflation in India is at multi-year low. That is important because lower food prices mean more disposable income in rural and lower middle income households. And historically, that is what drives consumption booms, from FMCG to entry-level vehicles, small appliances, and more. More consumption leads to more working capital loans, leading to more retail credit. Now, banks like HDFC and ICICI are betting that with inflation down, rate cuts in place, and the festive season around the corner, demand will pick up, and with it, the lending will revive. Now, are they being too optimistic? We'll know in the next quarter, but this is the bull case for banks. You are at the bottom and things are about to improve. Now, let's shift gears and look at deposits, the funding side. ICICI Bank saw 12.8% deposit growth year on year, with CASA, which is current and savings account, up by 14%. Now, that is very strong. HDFC Bank's deposit base grew even faster at 16.2%, but CASA growth was just 9%. Why the gap? Well, HDFC is playing catch up after the merger with HDFC Limited. It is focusing more on total deposits to fix its credit deposit ratio, which had gone above 96%. It wants to bring it closer to 87%, which is the pre-merger level. But CASA is what matters for margin defense. So HDFC is now pivoting to improve CASA in second half, targeting middle and upper and middle income customers, pushing product bundling and improving branch level activation. If they succeed, their margin compression could reverse faster. Despite all this, banks are not losing money. In fact, profits are up. ICICI Bank posted a 15.5% YOI jump on PAT to 12,768 crore rupees. HDFC Bank was up 12.2% to 18,000 crores. So what is keeping them afloat? Well, non-interest income is stable, operating costs are under control, and asset quality is still good. Sure, there were some seasonal agri slippages in Q1, but that is expected. Credit costs rose slightly, HDFC to 56 bips and ICICI to 50 bips, but those are still manageable. There are no red flags in the unsecured portfolio or credit cards yet. If bad loans don't rise, then earnings will not collapse. So now let's address the real question. As an investor, are we near the bottom? Well, here's how I would look at it. Credit growth has already slowed. We are not accelerating downwards anymore, we are stabilizing. Retail demand could revive post monsoon and MSMEs are holding up. Corporate loans are slow but not falling further. Now, margins have compressed, but most of the hit is priced in. So, another quarter of pain, then there should be stabilization. Food inflation is low. Now, this is bullish for consumption and indirectly for retail lending as well. Valuations are reasonable. HDFC Bank is trading at around 2.2, 2.4 book, and ICICI Bank is trading at around 2.8. Now, these are not crisis valuations, but they are also not highly overvalued. Balance sheets are strong, provisions are healthy, and no signs of asset quality blow up is there. CASA is also stable. So, yes, this may very well be the bottom of the cycle. If you're a long term investor with a 12 to 18 month view, this is likely an accumulation phase. The worst of the credit slowdown and margin compression is likely behind us. But stay sharp, watch these indicators in the next quarter. Number one, do FMCG and auto sales pick up after monsoons? Number two, do banks start growing CASA more aggressively? Number three, are private capex announcements picking up? And finally, how do rural credit and MSME demand trend during the festive season? This is not a buy everything moment, but it's a good time to do your homework. If you found this breakdown useful, hit that subscribe button, give this video a like, and share it with someone who's tracking the financial sector. And if you want more data-backed, no-nonsense insights on the banks, economy, and the investment trends, join our Telegram group. The link is in the description. Let's ride this cycle with eyes open because when the bottom is in, the upside can surprise.